Hey guys, Nathan Sprague here again with Guardian Financial Group. And in this video, I want to talk about how we can use indexed universal life insurance or IUL with the infinite banking concept. So I'm not going to get into all the details about what infinite banking is here. I've got another video where I talk exactly, explain what infinite banking is, how it works, and how you can use the strategy to achieve some very, very powerful results for yourself to essentially save money on the cost of any expenses or purchases you might make in life, especially larger ones, or improve the rate of return on investments you might make by essentially building your own self-serving line of credit and self-financing the purchases or investments that you make with that line of credit that you're building through a permanent specialized type of structured high cash value life insurance policy. And typically, if you look, watch the other videos, we're talking about whole life insurance, utilizing a specialized type of whole life insurance in order to do that, but it can be accomplished with IUL as well. So I'm not going to get into all the details about infinite banking. If you have questions about what infinite banking is and how it works, check out that other video first, then come back here. I'm also not going to get into too many details about how index crediting works. I've got another video about that where I really dive deep into the details and mechanics of how these companies are using this index crediting method to accomplish these results. I'll touch on it at a high level here, but I really want to dive into some numbers here and show you exactly how index universal life insurance or IUL can be used for infinite banking as well. We'll talk about some pros and cons and how that compares to whole life insurance. And you can decide for yourself which one you might think potentially makes more sense for you. So I've illustrated this. This is just with John's sample here, as you can see, just an example illustration. This is with a company called Allianz. They are, in my opinion, arguably the global leader in the world of index crediting products, whether it be index universal life insurance or indexed annuities. They're really the best of the best. There's a number of good carriers out there that provide some great IUL products, but in my opinion, Allianz is one of the best. And so, for the sake of illustration, I'm utilizing one of their IUL products here. So, without further ado, let's dive into some numbers. So, what I've done here, and going to use my highlighter here so I can draw around. This illustration is for a 35-year-old male with a standard health rating, so average kind of health rating, and non-tobacco, meaning he doesn't smoke cigarettes or chew tobacco. So 35-year-old male in average health who's contributing $2,500 per month into this infinite banking structure in an IUL, index universal life insurance product. So you can see here his age each year. And this column here, premium outlay, this is the total annual dollars that he's contributing to the policy. So this is $2,500 per month or $30,000 per year. And then over on the right, we see the account value here, or accumulation value as they call it, which I'm not going to spend too much time talking about that, because what we're really concerned with is the net cash value, which is the second column from the right, and then the death benefit here on the far right. So if you've watched my other videos about infinite banking, the way we structure this policy is that we're essentially purchasing the minimum amount of death benefit, or using the minimum amount of premium dollars rather, to go towards purchasing the death benefit, pushing up against the IRS's modified endowment contract limit, such that we can basically overfund the policy with extra dollars that go straight to the cash value, and get that cash value growing as quickly as we possibly can. And that cash value is growing utilizing these index crediting methods. And just at a very high level, again, I've got another video or two where I talk about index crediting and how that works. But index crediting essentially is tying your money to the stock market, but it's not invested directly in the stock market. And the net result, more importantly, is that your money tracks and it grows with the stock market. So you get to participate in the gains when the stock market goes up, but you are protected against losses when the stock market goes down. And again, watch my other video if you want to learn exactly how they do that. But the net result is that you get to participate in sometimes all of the gains, or at least some portion of the upside gains when the market goes up, and you are protected against losses when the market goes down, and you can never lose money in any given year. The worst you can do in a losing year is receive zero credit, so you get zero growth that year. But the net result is typically a fair amount more growth and more potential for growth compared to something like whole life insurance that's got very, very stable, predictable returns. But again, we'll get into some of those details here in a second. But looking at the numbers here with the IUL, we've structured this with what I would call an infinite banking type structure. If you look here in the first year, he contributed a total of $30,000 total premium for the year. He's got over $25,000 of that available in net cash value. That is pure tax-free liquid cash that he can begin utilizing within just 30 days after opening the account and starting the policy. He can start borrowing against that and operating as his own bank and implementing this infinite banking concept. And from there, his money is going to be compounding and growing year after year, utilizing these index crediting methods. I've illustrated this at a 6% growth rate, which, as you'll see here, we'll get into some numbers, is actually about 1% less than the prior 15 years performance. So to be a little conservative, I've illustrated that at a 6% growth rate. And you can see here, obviously, the death benefit that he's achieving as a result of allocating the minimum amount of dollars towards purchasing the death benefit. We've blended in a little bit of term insurance as a cheap way to buy some additional death benefit so that we can raise that modified endowment contract limit that allows us to put more of this $30,000 directly to cash value. So you can see here how his money's growing. By year 5, you look here, he's contributed a total of $150,000 into the policy. He's already got over $153,000 in net cash value at that point. So he's already ahead of the game, making net positive returns on his cash value relative to his total premium paid in. Excuse me, by the end of year 5, and has an additional $1.2 million in tax-free death benefit that's available to his beneficiaries if anything were to happen to him. And then you can see here, as time goes on, those numbers obviously improve as that cash value continues to grow and compound at the rate we've illustrated here at 6%. So if we stretch this out and kind of look further out into retirement, I want to show the other tremendous advantage. So the way I've illustrated this, I've said, let's assume he's going to pay in through age 66, and he's going to retire at average retirement age nowadays, which is 67. So if you look here, let me highlight a fresh sheet here so we can draw around, show some of these numbers. So you see here at age 66, this is the premium column right here. So beginning at age 67, you see zeros here. He's no longer contributing. So at this point, when he retires, this is the total contribution amount that he would have paid in. So he would have paid in $930,000 in total. And when he retires at age 67, he's got this number right here. So almost $2.7 million in tax-free savings inside of the policy. Again, after only paying in a total of $930,000, has almost $2.7 million of tax-free liquid savings for retirement. And in addition to that, almost a $4 million death benefit. So what we've done here, and what I've done with this policy, is I said, what income stream, what retirement income stream can we pull from this cash value and safely ensure that he's never going to run out of cash, never going to run out of death benefit for as long as he lives. And so that number is shown right here in this column. So as a result of paying in this $930,000 for 31 years and then retiring, he has over almost $2.7 million in tax-free savings. He can draw over $123,000 in tax-free retirement income and safely not have to worry about ever running out of money or ever burning through his death benefit. Now again, this is contingent on getting those 6% returns, and I'll get into some of the pros and cons here in a second, but as the numbers show here, he can safely draw $123,000 of tax-free income every single year and never have to worry about the policy eating away and eroding away at itself. So as we stretch this further out, I want to kind of look at maybe typical life expectancy. Let's highlight another section here so we can draw around. So let's just say that's 95. Let's say he passes away at the end of his 95th birthday, so the day before he turns 96. So look at the total numbers here. Again, paid in a total of $930,000 lifetime into the policy for those first 31 years. In drawing his $123,000 of tax-free income in retirement, he pulled almost $3.6 million of tax-free income out of the policy. So look at how huge that number is compared to the $900,000 he paid in. In addition, he's still got almost $3 million of tax-free liquidity in cash value inside of the policy and a $4 million death benefit. Now, if you were to pass away, technically these income distributions that he's taking are policy loans, and he's leveraging that participating loan feature that we talk about in that I talk about in the infinite banking video. So those are technically policy loans, which means any outstanding policy loan is going to be netted from the death benefit if it's a lesser amount, and that's going to be the net death benefit. So essentially, he's taken $3.6 million in total of income or policy loans, but he still has over $4 million in death benefit. So he would, or his beneficiary rather, would receive an additional $400,000 in tax-free death benefit if he passed away at the end of age 95. But in total, you're looking at over $4 million paid out relative to the $930,000 that he paid in. And again, that's all completely tax-free. The IRS cannot touch that money. So hopefully you see kind of the tremendous power that utilizing the infinite banking concept and that type of policy structure with an IUL can provide. I want to touch on two major differences compared to whole life insurance and in turn, essentially the risks that come along with using IUL in this type of strategy. So number one is the cost of insurance. So with whole life insurance, you're essentially buying in on day one, and your cost of insurance, your death benefit, the cost to buy the death benefit is fixed. You know exactly what that is throughout the entire duration of the policy, throughout your entire life. With IUL, the product is built on the back of essentially what's known as annual renewable term insurance. So effectively what the IUL product is doing is buying every single year, they're buying one additional year of term life insurance. So it's annual renewable term. So every year as you turn 1 year older, they're going to buy one more year of term life insurance, which is cheap in the early years, but as you get older and older, that cost obviously escalates. It's going to be a function of your age. It's not going to be a function of your health, because your health will be determined up front when you take out the policy. But as you get to be, 95 years old, that cost of that 1 year of term life insurance is going to be a lot more expensive than it is, when you're 35. But that's built into these numbers, and the reality is with advances in modern medicine and pharmacy, if we look at kind of the actuarial calculations of probability of death, I think the risk of that cost of insurance going up in the future is very low. The reality is, the cost of insurance as we get older over these next, 20, 30, 40 years would likely get less, because people are actually less likely to pass away or die earlier, and life expectancy ages keep getting longer and longer. So to me, that's a very, very minimal risk. The other risk, which is probably the bigger risk, is that especially in retirement, as you're drawing income off the policy, as we've shown here with this $123,000 income stream, if you have some poor performing years, in the stock market. So essentially, let's say you have 2 or 3 negative years in a row where I say negative meaning the stock market loses money. And so because you're utilizing the index crediting strategy in this policy, you're getting 0 credits for growth. So essentially your cash value is not growing at all because the stock market's been losing money, and so you're getting 0 credit, but yet you're still having to draw from your cash value to pay for your cost of insurance and keep the death benefit in force. That can potentially pose issues if you have, a lot of 0 years or just underperforming years in retirement. The policy can, essentially eat away at itself, and you could run the risk of the policy lapsing. But as we'll see here, we look at some historical numbers. In my opinion, that's a pretty low risk if we look at historical performance of the stock market. Averaging a 6% type rate of return with no risk of loss is a very, very realistic. In fact, it's probably underestimating what you typically could expect to see. So those are the 2 biggest differences compared to whole life insurance. The rate of return with IUL is oftentimes more. You're typically going to see on average a 6 to 7% type rate of return. Many of these products have uncapped growth potential or high caps, meaning that you can get 10 to 15% type years if the stock market does really well. And obviously you're going to see your money grow leaps and bounds more than whole life insurance will do. So you've got much greater potential for growth with the IUL. That's really kind of the major upside. And if everything goes according to plan, typically you're going to put yourself in a situation where you can use this tax-free savings, if you want, for a tax-free retirement income stream that pays you quite a bit more than a whole life insurance policy would pay. But there's pros and cons to both. I really love both products, whole life and IUL, but it just kind of depends on your preference and your potential appetite for risk as to which one you think might make the most sense for you. So having said that, I want to look at some historical performance here just to give you a sense for this risk for having some poor performing years. Let's see here. And this talks about, in this illustration, how the point-to-point index crediting is calculated. It's actually pretty simple. This number here shows a good number here. So with the way we've illustrated this policy with the different stock market indices I've chosen to illustrate this with, the average interest credited over the last, let's see the fine print here, since 2006, so 15 years, is 6.98%. So just under 7%. I've illustrated this policy at 6%. So the reality is, you could see a 1% greater gross return on those average returns if you see typical performance that we've seen here over these past 15 years. So trying to be conservative with that illustration. This talks about the possibility of receiving 0% interest. Obviously, again, for that to occur, the stock market or the indices that you have your money tied to have to lose money or get 0 returns, which certainly does happen. But when we look at a broader window of time and average those out, the reality is it doesn't happen often enough to, in my opinion, create a whole lot of risk. But the risk certainly is there, and we don't want to overlook that. So let's see here. I know we talked about index crediting, but I want to touch on some more historical performance. So this is one of the index. This is the Bloomberg U.S. Dynamic Balance 2 that I've allocated a portion of the funds into that strategy. So you can look here at historical performance here over the last 15 years. This table on the right here shows that the 10-year average is just over 8%. The 15-year average is just over 6.5%. Again, without ever running the risk of losing money in any given year. The worst you can do is receive a 0% credit. So again, you get to participate in the gains when the market goes up, but you're protected against losses when the market goes down. So Hopefully that provides an idea of what to expect. Again, this is very similar to how the infinite banking concept works with whole life insurance, but utilizing a different vehicle in index universal life insurance. And as we talk about in another video where we talk about design and structuring, design of these policies is absolutely key to getting them to perform this way. If you want to get your cash value growing as quickly as possible, looking at this, the second from the right column here, if you want to get this cash value growing as quickly as possible and, leverage the power of this strategy and operate as your own bank to, save money on expenses and improve rate of return on investments through self-financing those purchases and investments, you have to have your policy structured this way. So anyway, if you'd like to see some numbers for yourself, please contact me. My contact information is shown below this video. If you'd like to see some numbers, I'm happy to do that. Just have to learn exactly what it is you're looking to accomplish. But hopefully you see what this strategy can do when put inside of an Index Universal Life IUL product. And at the end of the day, it's up to you as to which one you think you might prefer, this versus whole life insurance. Both are great products and great strategies for long-term savings alternatives compared to a lot of traditional alternatives. And these are strategies that many of the wealthiest families have been taking advantage of and utilizing for literally hundreds of years. So anyway, hope you found this informative, and again, please don't hesitate to email me at the contact information shown below if you've got any questions or want to see some numbers for yourself. Thanks for watching and have a great day.